With the reporting season almost upon us, an early result today is for AFIC, the Australian Foundation Investment Company, the country's largest listed investment company for mainly retail investors. Net profit fell 5.8% to about $220 million compared to last year. And in these markets, there's been a drive for long-term investment and dividend yields. I spoke to AFIC Managing Director Ross Parker earlier. Ross Parker, welcome to the programme.
Thank you for having me.
Well, it's a pretty inauspicious day markets-wise to put your results out today. But you've actually had quite a tough year in terms of portfolio returns in the last 12 months, down 4.8%. How would you categorise your results?
Well, as you point out, it's been a tough environment. The overall market actually is down 6.7%, so we were pleased to be able to outperform the market, but obviously nobody's happy with a negative performance.
Was the decision earlier in the year to shift very much into blue chip stock a worthwhile decision, and have you continued to do that?
Well, we're a long-term investor. We're trying to capture dividends from the companies we invest in, so we're constantly trying to ensure that the portfolio is focusing on companies that can do that in the medium to long term. And our assessment is that the environment is challenging for quite a few companies, and so we've been moving out of the companies we perceive to be the weaker ones into the stronger ones, on the basis that in tough times the strong companies do better than the weaker ones.
Talking about medium and long term, there's a report out today on the mining boom shortening the prospects quite considerably. Now, you're a big holder of both BHP Billiton and Rio. What do you make of the Deloitte Access Economic Report saying, the strong bit of Australia's two-speed economy won't stay around for more than 2 years or so?
Well, the mining boom's always been a fairly complex issue, and those prices always do go in cycles, ups and downs, and you want to be positioned in that. When you're investing in those areas, you want to be positioned in the companies with low costs of production and with world-class scale assets, and that's part of our philosophy behind being in BHP and Rio. But of course, another aspect to the mining boom is the huge surge in new projects. And they take a long time to develop, and they also take a long time to physically construct. And I think that there are quite a number of projects that would go well beyond 2 years that are currently in construction phase. If you're thinking of the LNG projects, for example, in Gladstone, there are 3 at least, or maybe 4 being thought of there, and 3 actively under construction. There's the boom in northwestern Australia in gas and LNG projects over there.
Ross, these volatile markets, a lot of people think they're likely to continue. Listed investment corporations, LICs generally, are they a bit out of favour? I mean, I'm just looking at what sort of discount to NTA are you trading at the moment, and do you feel you're undervalued?
Well, the discounts and premiums that we trade at relative to asset backing moves around quite a bit. Usually, in difficult times, investment companies start to trade at a premium because investors like the conservative nature of the portfolio and the fact that we focus on companies with strong profitability and able to channel that through to their shareholders in dividends.
Yeah, but that doesn't seem to have happened this time round.
Well, I was about to mention that following the global financial crisis, investors had such a severe reaction to what had happened in the market that they've become very risk averse, and you're finding, if you talk to any of the retail brokers, that retail interest in equity investments has gone down quite a lot, and we think that's behind the fact that some of the investment companies are now trading at discounts. But I think the AFIC one has started to close that discount just in the last few weeks or so.
Do you also feel that the rise of exchange-traded funds, ETFs, provides new competition perhaps for you?
Well, certainly they're being viewed as another way of accessing the market, but they differ quite differently from listed investment companies in many ways. If you're looking at an exchange-traded fund that is an index fund that just takes what's in the index, then of course all they're giving you is the index return less whatever the cost of management is, which is usually fairly low. But if you're investing in an investment company, And take AFIC as an example, we only have 75 companies in our portfolio, whereas the index has 200. So we've made an active decision that there are 130 odd companies we don't wish to be invested in, and we're trying to focus on the ones we think make sense for our shareholders in the medium to long term.
You're a little heavier in Telstra than you were. Are you impressed with their performance at the moment? Why have you done that?
Our view is that we like the strong dividend yield, and notwithstanding the NBN competition, we think that from the medium to long term they look quite an attractive investment, and for many years they were laggards in terms of market performance, but I think in this year they've probably been one of the better performing companies in the market.
On the other hand, I see you've bailed out of Fairfax seemingly. At what point did you do that, and are you relieved?
Well, media is a challenging area at the moment in the markets. The traditional media companies are struggling hard to how they cope with the internet environment and how they make a profitable business out of their use and involvement in the internet. And I think and some of them have got quite a bit of debt. So our view has been we'd rather deploy the money in parts of the market we think would represent better value and with a clearer path forward.
Ross Barker, thank you so much for joining us today.
Thank you.